We take now chapter 4, and we've done so far chapter 1, chapter 2, chapter 3 of Company Law. My name is Mr. Williams of Fatima Training Institute, Center for CIFA Studies. My contact are 0727 Subscribe to our video or to our YouTube channel so that you may continue to get these classes as and when we update them or as and when we upload them. Now, last time we took classes of shares. We discussed what a class is, and we said a class of shares arises where the rights of the shareholders are too similar for the shareholders to consult. The classes that we discussed last time comprises of ordinary shares, preference shares, deferred shares, and employees shares. Those are classes of shares. Apart from that, we discussed variation of class rights, and I told you to make reference to the case in force versus abortum. So variation of class rights, we discussed that, and now we are moving on to share certificate. Now you can have the previous class in our YouTube channel. Meanwhile, I can just show you what is in the chapter 4 that we are doing so that you may continue. You can move ahead and maybe you find out what is discussed in those areas as far as these subtopics are concerned. So you have the classes of shares, your variation of class rights, share certificates, issue and allotment, that is the issue and allotment of shares, transfer and transmission of shares, transfer of shares under central depository system, mortgaging and changing of shares. So today we are moving to share certificate. Well, share certificate, as I said the other time, that this is like a document of ownership. I gave an example of a situation where you have an asset such as a motor vehicle. If you have a motor vehicle, definitely you should produce a document or a certificate as a proof that you are the owner of that particular asset. If you have a motor vehicle and if you do not have one, I pray that you have one in the future. So if you have a motor vehicle, or when you will have a motor vehicle, or you have a piece of land, and if you do not have one, I pray that you have a piece of land in the future. So if you have a piece of land, or when you have a piece of land, you must produce a document as an evidence that you are the owner, you are the true owner of that particular asset. If you have a motor vehicle, you have a logbook, which is a proof that you are the owner of this particular motor vehicle. If you have a piece of land, then you should have a title deed as a proof that you are the true owner of this particular piece of land. Now, the same applies to the shares. If you have shares, we define a share as a unit of capital. If you have invested in a company, it means that you have given this particular company some amount of money, and therefore you are part of the ownership of this particular company. The implication is that you should have a document as an evidence that you have shares in this particular company. So once you invest in company shares, then this particular company must issue you with a share certificate, which is an evidence that you have shares in that particular company. Now we move forward now and we define what a share certificate is, as I've just defined what it is. So I can just be writing, write this share certificate to say that this is a document issued by the company under its common seal, specifying the number of shares held by the registered holder and the extent to which they are paid. It is neither a title deed nor a contractual document and can only render the company liable through the equitable doctrine of estoppel. So basically, we have defined what a share certificate is. Now, I look at the contents of the share certificate. So once you have been issued with the share certificate by the company, what contents do you expect this share certificate to have? What is it supposed to contain? Like, for example, if you have a motor vehicle and you have a logbook, what contents do you expect to be contained in the logbook? Obviously, your name should be there. Things like maybe your ID number. So any information that evidences that you are the true owner of this particular motor vehicle. Now you have shares in a company, and the company has to issue you with a share certificate. In that share certificate, what are the contents? One is name and common seal of the company. So the share certificate must have the name of the company. If you have invested or you have purchased shares of Safaricom, for example, then your share certificate should contain the name of Safaricom because that is the company in which you have invested. And common seal. In chapter 1, we explained what common seal is. It's a kind of a stamp which represents the signature of the company. So the share certificate should have name of the company, the common seal of the company, date of issue, name of the registered holder, that is your name, number of the shares, how many shares have you purchased, class of the shares. So class of the shares means, are they preference shares? Are they ordinary shares? Are they deferred shares? Are they employees shares? So class of shares, the extent to which the shares are paid. If you are paying by installments, what percentage have you paid? So extent to which the shares are paid. The serial number of the shares. Shares usually have serial numbers. So the serial number of the shares and the serial number of the certificate. And that marks the end of the share certificate. So understand what a share certificate is and the contents of the share certificate. I present that one to you. If you have not written, you can just pause your video. You can pause your video and you write if I have moved fast. So share certificate is here. The meaning is there. The contents are here. The contents are there. So that is the share certificate. I move to share warrants. So I'm through with the share certificate. I am through with the share certificate. I move to share warrants. A share warrant. Now, with a share warrant, it is a document now which shows that a person or an investor is entitled to a certain number of shares in a particular company. Simple as that. Share warrants. This is a freely transferable certificate indicating that the bearer is entitled to specified shares of a stock. That's a share warrant. So it shows that you have entitled to receive a certain number of shares. So we are saying you do not have these shares. So a share certificate, as we have mentioned here, is where already you have the shares. You have purchased the shares or you have committed yourself to purchase these shares and therefore you have issued the share certificate. But here, the share warrant, you say you are entitled to, that is in the future. It's like situations where you have share options or something similar to that. So in this case, you're saying share warrant is a freely transferable certificate indicating that the bearer is entitled to specified shares of stock. This is a security that entitles the holder to buy the underlying stock of the issuing company at a fixed price called exercise price until the expiry date. The warrant is exercised when the holder informs the issuer their intention to purchase the shares underlying the warrant. It is a document issued by the company under its common seal, entitling the bearer to the shares therein mentioned and the dividends payable thereon. For a company to issue share warrant, the following conditions must be met. I believe you have understood what a share warrant is. Transferable certificate indicating that the bearer is entitled to specified shares of stock. That's a share warrant. This certificate is showing you that you are entitled in the future to have shares of a certain company. For a company to issue share warrants, so share warrants are not issued by any company. However, for a company to issue share warrant, the following conditions must be met. One, the company must be limited by shares. We discussed different types of companies in chapter 1. We talked about companies limited by shares and companies limited by guarantee. Shares or companies are, we say a company is limited by shares in those situations whereby the shareholders are paying for shares by installments. So in case the company is in financial difficulties and you have shares in arrears, a certain amount attributed to your shares which is outstanding or which is in arrears, then in case the company is in financial difficulties, you are only called upon to pay that amount which is in arrears, which is outstanding, because companies are usually limited, meaning your responsibility as an investor is only with respect to what you owe the company with regard to those shares. So you want maybe to know more about what is a company limited by shares and what is a company limited by guarantee. Just go to our YouTube, that is chapter 1. We have that class there. So here we are saying for a company to issue share certificate, the company must be limited by shares. The company must be limited by shares. Therefore, companies limited by guarantee cannot issue share certificates. So, the company must be limited by shares. Number 2, the shares must be fully paid. Shares must be fully paid. Number 3, the issue must be authorized by the articles. Section 114, subsection 1, provides that on issue of the share warrant, the company shall strike out of its register of members the name of the company to whom the warrant has been issued and shall enter in the register. 1, the fact of the issue of the warrant. Number 2, a statement of the shares included in the warrant, distinguishing each share by its number and the date of the issue of the warrant. A share warrant may be issued with a coupon to facilitate payment of dividends. A share warrant is a title deed or contractual document which is negotiable by mere delivery. A share warrant is an evidence that the bearer is the owner of the shares. Okay. For share warrants, I've said you note the meaning. What is a share warrant? Because the examiner may require you to differentiate between a share warrant and a share certificate. Quite examinable area. Just go through this. If you are writing, and maybe I've moved faster, you can pause your video and you write your notes. The share warrants. Write the meaning of share warrants. You just go through all this and take out. So just pause your video if you have moved fast and you go through this. There is one extra point from the other side, which is here. Now here we have differences between share warrants. We have differences between share warrants and share certificates. We have differences between share warrants and share certificates. Can you pause your video and you go through this 1 up to 10? Quite examinable area. Differences between share warrant and share certificate. Now, what is the difference? Now, one, a share warrant is a title deed or a contractual document, while a share certificate is neither a title deed nor a contractual document. So simply, a share warrant is like a title deed, but a share certificate is not like a title deed. Number two, a share warrant can only be issued with respect to fully paid up shares, while a share certificate need not have fully paid up shares. So for you to receive a share warrant, there has to be fully paid up shares. But for share certificate, you can receive share certificate even when you are paying for these shares by installments. Three, a share warrant is a negotiable instrument, while a share certificate is not. You know what negotiable instruments are? With introduction to law or commercial law, we talked about negotiable instruments like checks, like promissory notes, bills of exchange. These are negotiable instruments. They represent money, even though it is not money, like as in cash money. But a check, if you have a check, it is money because you present the check to the bank. It's cash and then you have money. But it's just a piece of paper which is an equivalent of the money written on that piece of paper. So a share warrant is a negotiable instrument, while a share certificate is not. A share certificate is not a negotiable instrument. All right. Number four, the bearer of a share warrant is not a member of the company. As a matter of fact, while the holder of a share certificate is a member of the company, as a matter of fact. We discussed about membership in chapter 3. A member, a shareholder. If you have a share certificate, you are a shareholder. You are a member. A member, as far as company law is concerned, is a shareholder. If you have a share certificate, you are a shareholder. But if you have share warrant, you are not a shareholder. The point is, when you have a share warrant, you are only being given a right, or you are entitled to have shares of the company in the future, the same way that you have share options. Okay, so the bearer of a share warrant is not a member of the company. So a bearer of a share warrant is not a shareholder. In other words, that is what we are saying. If you have share warrant, you are not a shareholder. That is why you cannot receive dividends if you have a share warrant. You can only receive dividends where you have a share certificate, because a share certificate evidences that you are a member of a company, which is not the case with holders of share warrant. So that's clear. The bearer of a share warrant is not a member of the company as a matter of fact, while the holder of a share certificate is a member of the company as a matter of fact. Number 5. Share warrants can only, or simply, share warrants are only issued by public limited companies, while share certificates can be issued by both the public and private limited companies. So share warrants can only be issued by public limited companies. But share certificates are issued by both public limited companies and private limited companies. Again, you look at chapter 1 in our YouTube and you find differences between public limited companies and private limited companies. We say a public limited company. These are companies which trade their shares in the stock exchange. Private limited companies are those companies which do not trade their shares in the stock exchange. Therefore, share warrants are only issued by public limited companies. So you can get a share warrant from only those companies trading their shares in the stock exchange can issue you with a share warrant. You cannot get a share warrant from a private limited company. That's a clear difference, that share warrants can only be issued by public limited companies, while share certificates are issued by both public limited companies and private limited companies. Number 6, share warrants are derived from share certificates, but a share certificate cannot be derived from share warrant. Number 7, the authority to issue share warrant is derived from the Articles of Association, while the authority to issue share certificate is mandatory under the Company Act. Number 8, share warrant is a conclusive evidence of title, while a share certificate is a prima facie evidence of title. Number 9, share warrant holder is paid dividend coupons, while share certificate holder is paid dividends. 10. While computing the share qualification of a director, we ignore share warrants, but we consider the share certificate. These are important points to note concerning differences between. Now, point number 10, I can just illustrate that before we come to the chapter dealing with directors. We are saying, point number 10, while computing the share qualification. Now, share qualification means here, before you become a director of a company, there is a certain percentage of shares that you are supposed to acquire. That's what we call share qualification. So if you want to become a company director, then you should acquire a certain percentage of shares in that particular company. So while computing the share qualification of a director, we don't consider the share warrants. We only consider the share certificate. That's the point. So if you are becoming a company director, you can say that because I have share warrants, then I meet the qualifications of becoming a director. That is not the case. We only consider the share certificate because the share certificate is an evidence that you have these particular shares. For share warrant, you do not have these shares. It only indicates that you are entitled to the shares of that company in the future. Just check out the differences between share warrants and share certificates. the differences between share warrants and share certificates. So 1 up to 10, we have them here. Just go through that. 1 up to 10, just go through that. 1 up to 10, you go through that. Okay, we move on from there. We go to issue and allotment. Issue and allotment of shares. Okay, shares can either be issued when a company is issuing shares. The shares can either be issued at par, at a premium, or at a discount. When shares are issued at par means nominal value. If the nominal value or the face value of shares is 20 shillings and you issue the same shares at 20 shillings, then we usually say that those shares are being issued at par or at par value. Issue at a premium. Premium means in excess of the par value. You are issuing the shares at a price above the par value. If the par value, note the par value is also known as the nominal value or the face value. If you are issuing shares at a price above the par value, then those shares are safe to have been issued at a premium. Now, for example, if your shares are a par value of 50 shillings and you issue the shares at 60 shillings, then there is a premium of 10 shillings. What is in excess of the par value is the premium. So issue of shares at a premium. Shares can as well be issued at a discount, whereby you are issuing the shares at a price below the nominal value. You are issuing the shares at a price below the par value. However, this is not allowed. Note that issue of shares at a discount is not allowed. For a company to issue shares at a discount, there are certain conditions that must be met, and I will discuss that in a while. Okay, so again, a point that students do confuse here is that, even though I'll be coming to that later, is what you call rights issue. Now, note here, there's a difference between issuing of shares at a price below the face value and issuing of shares at a price below the market value. Note the difference. Below the market value and below the face value. So if your shares are issued at a price below the face value, that is called issue of shares at a discount. If you issue the shares at a price, that is, if you are selling shares at a price below the market value, then that is called a rights issue. So try to understand the difference between issue of shares at a discount and issue of shares at, or just a rights issue simply. So I check, I've mentioned about issue of shares at a discount, issue of shares at a premium, and issue of shares at par. Now, issue of shares at par, this occurs when shares are issued at the face value stroke nominal value. For instance, shares with face value of shillings 20 being issued at shillings 20. So the shares have a face value of 20 and you are issuing them at shillings 20. So that's a par value. That's the issue of shares at par value. Next, issue of shares at a premium. This is where the shares are issued at a price above the face value. For example, shares with shillings 20 par value being issued at shillings 25. In this case, or in this issue, there is shillings 5 premium. The share premium account may be used in the following ways. And because we are saying when you issue shares at a premium, you are issuing them at a price above the face value. So where will the company take the difference? Because already we having share premium account. I believe you have done financial reporting and analysis. You've also done financial accounting, so you know how to present this information where a company has issued shares at a premium. You have to reflect what should appear in the ordinary shares account and what goes to the share premium account, because all these transactions should be reflected on the financing side of the company's statement of financial position. So when a company issues shares at a premium, it means that it is issuing the shares at a price above the par value, and therefore there is an extra figure. So where do we take this extra figure? Where do the company take this extra figure? So the share premium account may be used in the following way. So that extra amount, where does the company take that extra amount? One, to finance a fully paid bonus issue. A bonus issue is the issue of shares to the existing shareholders for free. So even though we are saying this issue is for free, then the amount which is financing the bonus issue originates from the share premium. Number two, to write off the preliminary expenses of the company. The preliminary expenses are those expenses incurred within the process of company formation. They are incurred before the company is fully incorporated. So that premium account can be used to write off the preliminary expenses of the company. Number three, to write off the expenses of or the commission paid or discount allowed on any issue of shares or debentures of the company. Number four, to provide for the premium payable on redemption of redeemable preference shares or debentures. I discussed about redeemable preference shares last time. Okay, those are the uses of the share premium account. You can just if you are writing, you pause your video. So we are discussing about issue and allotment of shares. Issues can you can issue shares at either par value or at a premium or at a discount. So can check issue of shares at par, issue of shares at a premium, and this is how you can use that share premium account. Then I'll move now to issue of shares at a discount. So just pause your video and you go through that. I will move now to the next. And that is issue of shares at a discount. I have said that the issue of shares at a discount, it occurs where the company issues shares at a price below the nominal value. However, such is not allowed. However, for a company to issue shares at a discount, there are certain conditions that has to be met, and that is what we discuss. So, issue of shares at a discount. This is where a company issues shares at a price below the par value. For instance, a company issues shares with a par value of shillings 20 at shillings 15. Issue of shares at a discount is not allowed in Kenya by the law. However, a company may issue shares at a discount in the circumstances prescribed by Section 59 of the Act. Circumstances for the issue of shares at a discount, that is Section 59 of the Company Act, are as follows. So note the meaning of issue of shares at a discount, what it means, and then circumstances to be met before a company issues shares at a discount. One, so for a company to issue shares at a discount, it has to meet these conditions. One, the issue must be authorized by a resolution of members in a general meeting. So there has to be a resolution to authorize the issue of shares at a discount. Number two, the issue must be sanctioned by the court. Number three, the shares must be issued within 1 month of approval or such extended time as the court may allow. Number four, at least 1 year must have elapsed from the date the company commenced the business. Number five, the shares must belong to a class already issued by the company. Number six, particulars of the discount must be disclosed in the prospectus of the company, failing in which the company and every person in default is liable for a default line. So can you look at conditions to be met before you issue shares at a discount? So we have already discussed what is issue of shares at a discount, the meaning of issue of shares at a discount. So once you have understood what it means, the other important point to note is that issue of shares at a discount is not allowed by the company law or by the laws of Kenya. However, for a company to issue shares at a discount, it has to meet these 6 conditions. Okay, pause your video and you write those notes. Okay, I move away from that. I look at something else known as bonus issue. Bonus issue means issue of shares to the existing shareholders for free. You have mentioned somewhere the use of share premium account, and you have said one of the uses of the share premium account is to finance the bonus issue. Now we have come to bonus issue now, and that is where we are. So what is a bonus issue? A bonus issue means issue of shares to the existing, underlying existing shareholders for free. So for you to get bonus issue, you must be an existing shareholder. You must already be a shareholder in that particular company. So issue of shares to the existing shareholders for free. So this is the issue of shares for free to the existing shareholders. The shares are financed by retained earnings for the company. For bonus issue to be effected, the following conditions are necessary. So conditions to be met when a company is issuing bonus issue. One, it must be authorized by the articles. When I talk of articles, I mean articles of association. We need constitutive documents, that is articles of association and memorandum of association. So that bonus issue must be authorized by the articles of association. Number two, the nominal capital of the company must be sufficient. Number three, the shares must be issued in the proportions prescribed by the articles, the proportions. You can have a situation where you are told for every 2 ordinary shares you have, you receive 1 bonus issue. That's a proportion. Or for every 5 preference shares that you have, you will receive 2 bonus issues. So that means if I have 10, if the proportion is for every 5 ordinary shares I have, for every 5 I'll receive 1 bonus issue. So if I have 10, I'll be receiving 2 bonus issues. These are the proportions that we are talking about. So the issue must be the shares must be issued in the proportions prescribed by the articles. Number 4, the issue must be recommended by the board at the board meeting. Number 5, it must be authorized by an ordinary resolution. We'll be coming back to resolutions. An ordinary resolution is a resolution which requires not less than 50% of the votes. Resolution which requires not less than 50% of the votes. And number 6, it must be sanctioned by CMA. CMA means Capital Market Authority. And number 7, a return must be made to the Registrar of Companies within 60 days. A return must be made to the Registrar of Companies within 60 days. So I have advantages of bonus issue to the existing shareholders. 1, it increases the shareholders' security for loans. Number 2, there are extra dividends to the shareholder. Number 3, the shareholder will get extra shares without diluting the control of the company. Number 4, shareholders will get tax-free profits since this is a capital gain. Number 5, the shareholder will get capital gain if he sells the shares in the future. These are advantages of bonus issue to the existing shareholders. Then we have disadvantages. Disadvantages of bonus issue to the existing shareholders. 1, in case the shareholder sells the shares, it will dilute the control of the company. Number 2, it reduces the EPS. EPS means earning per share. It reduces the EPS of the company because of extra payment of dividends. Number 3, it is of no much benefit to the shareholder since it is just an acknowledgement of what rightly belongs to the shareholder. Number 4, bonus issue will increase the supply of shares in the market, and this will lower the share price. You also have advantages of bonus issue to the issuing company. Number 1, there is no interruption in the earnings of the company. Number 2, it is cost-free since it has no flotation cost. Number 3, it is cheap to administer since no financial intermediaries are needed. Number 4, the cash position of the company is not affected. Number 5, it boosts the company's investment, hence a better return to the shareholders. Then we have disadvantages of bonus issue to the issuing company. Disadvantages of bonus issue to the issuing company. Number 1, it can affect the growth of the company if the funds are invested imprudently. Number 2, it increases the permanent costs of the company in form of future dividends. Number 3, it can deplete the retained earnings of the company. Number 4, if the shareholders sell the shares, there will be increase in the supply of shares in the market, and the prices in the market will fall. Number 5, if the shares are sold to the outsiders, the control will be diluted. Okay, I present that to you so that you may have time to go through. So understand what a bonus issue is. Issue of shares to the existing shareholders for free. Understand conditions to be met before a company issues or makes a bonus issue. Conditions to be met. Conditions to be met are here. You understand Advantages of bonus issue to the existing shareholders. Disadvantages of bonus issue to the existing shareholders. So we have advantages and disadvantages. You have on the other side one extra here. Advantages of bonus issue to the issuing company. These are advantages of bonus issue to the issuing company. Disadvantages of bonus issue to the issuing company. You pause your video, you understand those points. I go to rights issue now. So I'm through with bonus issue, the issue of shares to the existing shareholders for free. I go to rights issue. I say that do not confuse rights issue with issue of shares at a discount. You said shares are issued at a discount where a company issues shares at a price below the par value. The par value. Par value is also known as face value or nominal value. So once if a company is issuing shares at a price below the face value, that's discount issue. Now rights issue, note the difference here now. Rights issue is the issue of shares to the existing shareholders at a price below the prevailing market price. So we are going to the stock market. We find that in the market, one share is selling at 15 shillings, but I sell these shares to an existing shareholder at 10 shillings instead of 15 shillings. So we are looking at in the market, these shares are selling at how much? If I'm to issue now these shares to the existing shareholders at a price below the prevailing market price, then this is basically the rights issue. It is not a discount. I'm insisting that because I've seen many students confused between issue of shares at a discount and rights issue. I should repeat this one last now, that shares are issued at a discount when the shares are issued at a price below the face value. Underline that. Below the face value. The other name for face value is nominal value and par value. So if the issue is below the nominal value, that's a discount. That's the issue at a discount. Rights issue, we are going to the market. And for rights issue, this must be made to the existing shareholders, not new members, not somebody who has never been a member. So a rights issue occurs where a company issues shares to the existing shareholders at a price below the existing market price. Okay. So this is the issue of shares to the existing shareholders at a price below the prevailing market price. The following conditions must be met before rights issue is made. These are the conditions to be met. 1. It must be authorized by the articles. Articles here means articles of association. So it must be sanctioned by CMA. CMA means Capital Markets Authority. It must be recommended by the board. Board here means board of directors. It must be authorized by an ordinary resolution of the members. We'll be looking at types of resolutions. Then a return must be made to the registrar. Those are the conditions which must be met before a company issues a rights or makes a rights issue. And advantages of rights issue to the existing shareholder. 1. It will increase the shareholders' voting rights. Number 2, it boosts the future dividends to the shareholders. Number three, in case the shareholder sells the shares, they gain profit, which is an additional income. Number four, additional shares will boost the security to the shareholders in case they need loan. Number five, there is no dilution or the control. These are advantages of rights issue to the existing shareholders. The next is disadvantages of rights issue to the existing shareholders. Now, number one, it decreases EPS, that is earning per share. It will reduce earning per share. I believe you are doing financial reporting and analysis, so you understand how to calculate earning per share. You may have been told if you have done earning per share. You take earnings attributable to the ordinary shareholders divided by weighted average number of shares. So by so doing, you will have calculated your EPS, your earning per share. So we are saying it reduces the EPS. Why? Because once you increase, because you are taking all the earnings attributable to the ordinary shareholders divided by weighted average number of shares. So if you are dividing by a bigger figure, once you make a rights issue, obviously your shares are increasing. Therefore, to get the EPS, you are dividing your earnings attributable to the ordinary shareholders by a very big figure, and therefore your EPS now reduces. So once you make a rights issue, your earning per share generally comes down. Okay, that is a disadvantage. That's a disadvantage. We are taking disadvantages of rights issue to the existing shareholders. We are saying it decreases the EPS. Number two, the existing shareholders are given short notice to buy the shares, which leads to upheaval among the shareholders. There is reduced retained earnings because of the increased dividends. Number four, if the shareholders decide to sell the shares, there will be increased supply in the market, thereby lowering the prices of the shares in the market. Okay, do we have anything else? Number five, the funds raised are invested at the discretion of the board of directors in the areas of their interest. This will prejudice the interests of the shareholders. Okay, let me take you through similarities between bonus issue and rights issue. Similarities. Are they similar? Or they are as different as the heavens and the earth? Okay, we say they are as different as light from darkness. Okay, are there similarities? Because the bonus issue, we are saying these are shares issued to the existing shareholders for free. Rights issue of shares to the existing shareholders at a price below the prevailing market price. But are they similar? One similarity, both are issued at the discretion of the directors. So both have to be authorized by the directors in line with the provisions of the Articles of Association. So both are issued at the discretion of the directors. If you are issuing bonus issue, if a company is making bonus issue or rights issue, definitely in both cases we have to look at whether such is allowed by the Articles of Association. Okay, number two, both are only issued by limited companies. Number three, both issues are reserved to the existing shareholders of the company. So bonus issue and rights issue can only be made to existing shareholders. Number four, in both cases, shareholders can sell their shares to earn capital gain. Five, both may be invested without the consent of the existing shareholders. Number 6, both are issued to the existing ordinary shareholders in proportion to their existing shareholding. Then differences between rights issue and bonus issue. What are the differences between bonus issue and rights issue? One difference is obvious as far as their definition is concerned. Bonus issue is an issue to the existing shareholders for free. For rights issue, a rights issue is the issue of shares to the existing shareholders at a price below the prevailing market price. Now, with bonus issue, there is no cash raised because they are free. The company will not receive any cash, but the shares will increase. For rights issue, there is cash raised because we are issuing them at a certain price which is below the prevailing market price. So for bonus issue, there is no cash received by the company. For bonus issue, the company receives no cash. For rights issue, the company receives cash. This is a difference there. So the issue is not given pari passu. The issue is given pari passu, and bonus issue depletes the reserves of the company, and it does not. So because we are saying that for bonus issue is usually financed from the share premium account, so it reduces now the company reserves. For rights issue, that is not the case. Now the other thing that I'll give you, even though I'll come back to that later, is the differences between shares and stock. Read in advance differences between shares and stock. Shares are in units. Stocks are not in units. You can have 1 share, 2 shares, 3 shares. Stocks are not in units. Shares are issued directly by the company. Stocks cannot be issued directly by the company. Shares need not be fully paid. Stocks must be fully paid. You can pay for shares by installments, but for stocks, you don't pay by installments. Shares may be numbered, stocks are not numbered. Fractional transfer is not permitted. You cannot transfer shares by fractions. You can transfer the entire share. You cannot transfer half of a share. You do not have half a share or a quarter of a share. So fractional transfer is not permitted with respect to shares. For stocks, there can be fractional transfer. That is it about rights issue. Okay, rights issue, you say, is the issue of shares to the existing shareholders at a price below the prevailing market price. Now you can pause your video and So you have rights issue here. You pause your video, you go through rights issue. Look at advantages of rights issue to the existing shareholder and disadvantages of rights issue to the existing shareholder. We have them there. The rights issue here. You have advantages here, you have disadvantages there. Now we have similarities between bonus issue and rights issue. Similarities between bonus issue. Similarities between bonus issue and rights issue. Then we have differences between rights issue and bonus issue. Differences between rights issue differences between rights issue and bonus issue. You have differences between rights issue and bonus issue, differences between shares and stocks. You have that. Now you pause your video and you have those important points. I will move to transfer and transmission of shares. Transfer and transmission of shares. Chapter 3, we did membership of a company. Refer to our YouTube. Chapter 3. Important things that we covered was how to become a member of a company. Membership of a company. How to become a member and how to cease from being a member. How to stop. How to stop from being a company member. Now, transfer and transmission are two terms that we came across in chapter 3 concerning membership of a company. Now, looking at transfer. Transfer, we say, is voluntary, whereas transmission is not voluntary. Transmission occurs like in case of death of a member or in case of bankruptcy of a member. So transmission of shares can either be, it can occur when a shareholder passes away or when a shareholder is bankrupt. That's transmission. Transfer is like I purchase shares from an existing shareholder. Then that's a transfer. You see, it is voluntary. Transfer is voluntary. It's now this movement of shares from one shareholder, that's from an existing shareholder to another shareholder, which is voluntary. That's a transfer of shares, which can either be full transfer or partial transfer. If you are making a full transfer, if for example you have 100 shares, you sell the 100 shares to a new shareholder, then that's a full transfer. It can as well be partial transfer. You have 100 shares, you only sell part of it. You are selling 80 shares, you remain with the 20. So if you make a partial transfer, you don't stop from being a member because it is only the proportion of your shareholding that is affected as you remain an existing shareholder in that case. But if you make a full transfer, then you stop from being a member. Your name has to be deleted from the share register. So we look at transfer and transmission of shares. Transfer and transmission. Before a transfer of shares is effected, the parties are required to complete a proper instrument of transfer approved by the Securities Exchange. In my book, I have written approved by Nairobi Securities Exchange. So that is Kenyan situation. Depends with your country, where you are. So basically, these instruments of transfer should be approved by Securities Exchange. This instrument contains the following. So I want to transfer my shares to you. I'm selling the shares to you, either fully or partially. So we have to take instrument of transfer from the Securities Exchange, which should have these contents: one, full names and address of the company, the number of shares sold in words and figures including their description, full names and address of the transferor together with his signature, full names and address of the transferee together with his signature, the date of the transfer, name, signature, occupation, and address of the witness, name and address of the person lodging the application of the transfer now. I just have give you that. You can take up that. Take up transfer and transmission is what we're doing. Can you read those 7 points there before we move on? You pause your video and you take up that. Take up that. I move on to the other side. You continue with this points here, and you look at the procedure of transfer, which can either be total transfer or partial transfer. These transfers can either be total transfer or partial transfer. Can you look at the process? The procedure of transferring shares, where the transfer is total, that is, you are transferring 100% to the purchaser, or partial transfer, where you are not transferring all the shares. In public companies, the transfer of shares is free, but in private companies, the transfer of shares is restricted by articles. Now, procedure of transferring shares, the procedure where you are making total transfer. You want to sell all your shares 100%. You want to sell all your shares 100%. The parties enter into an agreement to sell and buy the shares. I'm selling my shares to you. What process are we supposed to follow? And in this case, I'm making full transfer. I'm selling all my shares to you. The process, the parties enter into an agreement to sell and buy the shares. Number two, they execute the proper instrument of transfer. Step number three, the executed instruments of transfer must be presented for stamping and payment of tax. Remember, when you are transferring shares, you have to pay tax to the government. So that will be the step number three. Step number four, the executed instruments of transfer and share certificate are presented to the company for registration of the transfer. Number five, on the registration of the transfer, the share certificate is cancelled and another issued in the name of the transferee. That's the process of making total transfer, where an existing shareholder is selling all the shares to a new shareholder. That's the process that you follow. But if you are making a partial transfer, you are not selling all your shares now. I have, for example, 100 shares and I want to sell 50 shares to you, meaning I'm just reducing my shareholding. I'll still remain a shareholder with a less shareholding. Partial transfer. The parties enter into an agreement to sell and buy shares. Number two, they execute the proper instrument of transfer. Number three, the instruments of transfer and the share certificate are presented to the company for certification of the transfer. Number four, the share certificate is retained by the company for cancellation. Number five, the certified instrument of transfer is presented for stamping. Number six, the certified instrument of transfer is presented to the company for registration. Number seven, on registration, the share certificate is cancelled and two others are issued in the name of the transferor and the transferee for the shares retained and acquired, respectively. So understand the process that you follow where you are making total transfer and where you are making partial transfer. Total transfer means you are selling all your shares. Partial transfer, you are not selling all your shares. Again, you go through the process. You go through the process, understand the procedure of transferring shares. That's total transfer. Total transfer, the process, understand the 5 steps. Partial transfer, you understand the 7 steps. You pause your video and you understand that. I move to certification of transfer. Certification of transfer. Certification of transfer say that this is only available in the case of partial transfer. So certification of transfer only occurs where you are making a partial transfer. You are not selling all your shares. You are selling part of the shares. So certification of transfer occurs only where you are making a partial transfer. It is a representation by the company to any person who relies on the instrument of transfer that documents showing a prima facie title to the shares were produced to the company. It is effected by inserting the words certificate launched. There are circumstances when certification is necessary. Circumstances when certification is necessary. Circumstances when certification is necessary. Number 1, where the transferor is transferring only part of his holding. We have mentioned that certification occurs where you are making partial transfer. You don't need certification where you are making full transfer. So circumstances when certification is necessary, number 1, is where the transferor is transferring only part of his holding. Number 2, where the transferor is transferring all his shares to 2 or more transferees. So you may be making total transfer, but you are transferring to 2 or 3, more than 1 person. In that case, you need certification. If you have 100 shares and you are selling 50 to James and the remaining 50 to Mary, then in that case you need certification. It's the other situation where certification is necessary. So where the transferor is transferring all his shares to 2 or more transferees. Number 3, where the transferor has not yet received a certificate from the company but has been issued with a document of title to the shares, e.g., an allotment letter. Number 4, where the transferee is not satisfied with the transferor's title to the shares, e.g., where there is a conflict in some of the information between the certificates with other relevant documents. Okay, you have certificate of transfer. You have circumstances when certification is necessary. Circumstances when certification is necessary. Circumstances when certification is necessary, you have them here, and you have the meaning here. I move on to the next. So we go to refusal to register transfer of shares. Refusal to register transfer of shares. I can transfer my shares to you, but when you go to registration, the company or the registrar of companies may decline to register that transfer. So refusal to register transfer of shares. The board of directors can refuse to register the transfer of shares under any of the following grounds. Number 1, if the transfer is prohibited by a court order tribunal or any law. So any transfer which is not within the law will not be registered. If the transfer is likely to result to a change in the composition of the BOD and would be prejudicial to the interest of the company or to the public interest, then such will not be registered. If the instrument of transfer is not proper or has not fully been stamped, if the instrument of transfer is not proper or has not fully been stamped. Number 4, if the transfer is in contravention of any law. And number 5, if the transfer is in contravention with the conditions of listing agreements. Those are the circumstances under which the transfer will not be permitted. Can you go through that? Refusal to register, transfer of shares. Refusal to register, transfer of shares. So you're 1 to 5. Those 5 conditions, you understand them. So next is forged transfer. Forged transfer. Now there is a transfer through forgery. And we said sometimes back, one of the ways of becoming a member of a company is through ESOPL. You remember that? You know what ESOPL means. Now here there is forged transfer. We are moving shares from one person to another, but this is through forgery of the documents. Where a transfer is effected through forgery, such a document is a legal nullity. It confers no rights and imposes no obligations on the parties. If the certificates are not signed by the proper officers but are forged, the company will not be held liable. Therefore, it follows that number 1, where the true owner of the shares is being removed from the register of members, the company must restore his name and pay him any dividends which have been declared during the time when his name had been missing from the register. Number 2, the person who launched the forged transfer for registration must indemnify the company against any loss it suffers as a consequence of the registration. And number 3, if the company issues a share certificate to the transferee under the forged transfer, and the transferee sells or mortgages the shares to another person who, relying on the certificate, takes them bona fide for value, the company is stopped from denying the transferee's title to the shares. Lastly, implied terms in the transfer of shares. Implied terms in the transfer of shares. 1. That the transferee will pay the price of the shares. That is an implied term. That is, once the shares are being transferred to you, then you have to pay for those shares. So it is an implied term that the transferee will pay the price of the shares. Number 2, that the transferor will hand over genuine instruments of transfer and the share certificate. Number 3, that the share certificate carries the rights and interests which it purports to convey. Number 4, that the transferor will do nothing to prevent the transfer from being registered or delay the process. Number 5, that the transferee will identify the transferor with respect to all the cause and the liabilities arising on its shares after transfer. Now we have forced transfer, forced transfer, forced transfer. Understand that one. Then implied terms in the transfer of shares. These are called implied terms in the transfer of shares. Implied terms in the transfer of shares. So we have done transfer of shares. So transfer is like where you are selling shares willingly, freely. Transfer of shares. You go to transmission now of shares. I've mentioned earlier that transmission is not voluntary. It occurs where there is either death of a member or bankruptcy of a member. So transmission of shares. This is an involuntary conveyance where title changes hands by the operation of the law. Transmission of shares takes place in two ways. Transmission of shares takes place. Transmission of shares takes place. Transmission of shares takes place in two ways. Namely, one, transmission by death. Transmission by death. Upon death, the shareholder ceases to be a member and his shares passes to the personal representative who becomes a member when entered in the register of members. However, he is free to transfer the shares to a third party before his name is entered in the register. Okay, so that's transmission by death. So once a shareholder passes away, obviously the shares will be taken over by his or her personal representative. So transmission by death, and then you can have transmission by bankruptcy. When a member is declared bankrupt, his shares pass to the trustee in bankruptcy, but remains as a member as long as his name remains in the register. So bankruptcy. So transmission of shares. We have transmission. We have transmission of shares. We have transmission of shares. So transmission by death. Understand what happens if a member passes away. We don't talk of transfer. Shares will not be transferred. They will be transmitted. So death and bankruptcy results to transmission of shares. So transmission is that one. And then we have transmission by bankruptcy. You can read that. Transmission by bankruptcy. So from there we go to lien. Lien of shares, cause of shares. Now lien, with the introduction to law, if you've done introduction to law, lien means the right that you have over another person's property. The rights that you have over another person's property. So lien of shares. Under what situations, under what circumstances can your shares be taken over by somebody else, and that other person exercises rights over your own shares? It's like I owe you some money, you come and you pick this book, you go with it. And it is a good book for principles of auditing. You are doing auditing, This is a good book for auditing. I'm the author for this book. I've also written other books here. You can see a good book here. This is for some book for fixed income investment analysis for certified investments and financial analysts. I'm the author for this book, among others. So, in case you need books to do with what you are doing here, I can see also there are others here. This for accounting, this for introduction to financial accounting. So we have many books which you have covered. If you need some books, you can just call us. You have my number, and I'll still give you more details concerning our operations. So, Lian, I was asking, if I owe you money, you may come to my office and you say, you have my 1,000 shillings. So I take this book and go with it. Or I take this computer and go with it until you pay me my money. So what you are doing is you are exercising lien over my computer. You are exercising lien over my book. You are telling me, I will take one of your assets, which is an equivalent of what you owe me until you pay me. When you pay me, I will return your asset. You are exercising lien over my property. Now here we are looking at lien with respect to shares. There are circumstances under which a person may take your shares and exercise right over those shares. Now this is a right, lien of shares. This is a right, claim, or interest which a company or a third party may have on the shares of a member on account of an obligation owed by the member. A lien may be granted by the articles in favor of the company for the amount outstanding or on partly paid up shares, and such a lien extends to dividends payable on the shares. I take that one again. Lien on shares. This is a right, claim, or interest which the company or a third party may have on the shares of a member on account of an obligation owed by the member. A lien may be granted by the articles in favor of the company for the amount outstanding or on partly paid up shares, and such a lien extends to dividends payable on the shares. If, for example, I'm paying for shares by installments and I've not cleared paying for these shares, the company may take those shares and the company now will start receiving dividends on my behalf. So they are exercising lien over those shares. Next is calls on shares. A call, this is a demand by the company through its directors to members with amounts outstanding on shares held to pay the same or any installment thereof. It is common where shares are paid for in installments. A call, when we talk of a call, there are situations where shares are being paid for by installments. Specifically for those companies limited by shares. Because if companies are limited by shares, you are paying by installments, mostly. So a call means a company is telling you to pay for your balance with respect to those shares. So a call is a demand by the company through its directors to members with respect to amounts outstanding on shares held to pay the same or any installment thereof. It is common where shares are paid for in installments. Now let's have rules governing calls on shares. Rules governing, now this is a call. Rules governing calls. We are saying a call is being made whereby You have purchased shares in a company, but you have not fully paid for these shares. So you have some money to pay the company which relates to the shares which you purchased from that company. So rules governing calls of the shares. One, directors may from time to time make calls to the amount and be paid on shares is a rule. The directors may from time to time. They are telling you you have certain arrears with respect to our shares. Pay for this. So directors may from time to time make calls to the amount and paid on shares. Number two, such calls must be separated by at least 1 month. So if you make one call today, you omit 1 month. The next call, if you make call on January, then February you cannot make a call. You make a call by March. So these calls must be separated by at least 1 month. You can be, the directors cannot be telling shareholders to pay those arrears every day. So a call, the such calls must be separated by at least 1 month. Number three, a call must not exceed a quarter of the nominal value of the shares. So that if, for example, you purchase the shares worth 100, a quarter of 100 is 25. So you cannot make a call which is more than 25. So those calls must not exceed a quarter of those values in question. So a call must not exceed a quarter of the nominal value of the shares. Number four, members must be accorded a notice of at least 14 days. A call is deemed to have been made at the time the resolution authorizing it is passed. So calls are assumed, that call is assumed to have been made on that particular date when the resolution to make the call was made, not when you receive that notice or that call. It's when the date of resolution. If the board of directors make a resolution today to make a call, then it is assumed that the call was made today, the date of resolution. A call is deemed to have been made at the time the resolution authorizing it is passed. Number 6, directors are empowered to postpone or revoke a call before it is effected. Number 7, joint holders of shares are severally and jointly liable to pay all calls made. You have joint holders of shares. You can hold shares together. 5 people may have contributed to invest in a company. So that's a joint ownership of shares. So the joint holders of shares are jointly liable to pay all the costs because they have invested in these shares as joint persons. When it comes to costs, then they pay jointly. If a member fails to pay a call on appointed dates, he is bound to pay interest at the rate of 5% per annum. So that's a call. Next is forfeiture of shares. So to forfeit is to cancel the shares. Because if the directors make their calls, they are telling you, you have not completed paying for your shares. They make the first call, the second call, the third call. And because you can't pay, they will forfeit those shares. They cancel your name from the list of members and they can repossess those shares and they can sell to somebody else. That is forfeiture of shares. So forfeiture is the loss of shares by a member at the instance of the company for non-payment of a call. If they make the call, they are telling you to pay for your balance with respect to the shares which you have purchased. So if they realize that you are not paying your balances with respect to those shares, they will forfeit the shares. So forfeiture of shares is the loss of shares by a member at the instance of the company for non-payment of a call. It is a confiscation. To confiscate is to take away. So it is the confiscation of the shares as a penalty for the non-payment of the call is a penalty. They are forfeiting your shares to penalize you because you are not paying what you owe them. The articles of association must authorize the same, and the directors must exercise their powers in good faith. If a shareholder fails to pay a call, the directors may serve a notice on the member demanding interest and payments. The notice must specify 1. The due date. Number 2. The fact that the shares are liable for forfeiture. And number 3. At least 14 days notice must be given. The forfeiture of shares is concluded by a statutory declaration sworn by a director or company secretary to the effect that the shares have duly been forfeited. So we have calls of shares, so you got the lien of shares. You have said lien means the right that you have over another person's asset. In this case, lien of shares is the right exercised by a third party over your shares. You have calls on shares. A call is a reminder, is a notice that you are being given by the company telling you that you purchased shares in this company and you have not fully paid for those shares. So why can't you pay for the balance? So the call, a call here means that they are telling you to pay for the balance. So if they make calls, the first call, the second call, the third call, then you don't respond or you don't pay, they will forfeit your shares. They will cancel your name from the share register. They will confiscate those shares and they can issue them to a different person. So you can go to the meaning of lien of shares, call of shares, and forfeiture of shares. So we have lien of shares, you have done that. You move to cause of a share. What cause of shares, what a call is. Then rules governing calls on shares. Rules governing calls on shares. Once you have understood what a call is and the rules governing calls on shares, you move to forfeiture of shares. And then forfeiture, you go to that. And go to surrender of shares. Surrender of shares. We move to surrender of shares. Surrender of shares. Surrender of shares, you read this. These notes relate to surrender of shares. This is the loss of shares by a member at his instance or option. What do I say? Surrender of shares. This is the loss of shares by a member at his instance or option. The member gives up the shares to the company. It is neither recognized by the Companies Act nor authorized by Table A. Surrender of shares may occur in 2 instances. 1, where the shares are accepted to avoid the formality of forfeiture, where fully paid shares are accepted in exchange for new shares of the same nominal value surrendered. That's forfeiture of shares. Okay, I move to something else now. And this is the last portion. Here. So here we have transfer of shares under central depository system. Transfer of shares under central depository system. That is CDS. So in this case, when you are transferring shares manually, if you are transferring shares manually, the implication is that if you are transferring shares manually, the implication is that we are filling these forms manually and then everything else is being done manually. But you can have it the transfer of these shares can be done in a computerized system. In this computerized system of transferring shares, we do so through central depository system. So both of us should open an account whereby these transactions are done not necessarily through stockbrokers. CDS, Central Depository System. Central Depository System acts as a means of representing ownership and movements of securities. Central Depository System account holders enjoy the convenience of obtaining electronic securities transfer and trade settlements. Now this one I'll move a little bit faster. So CDS, you can do more, you can read about CDS, that is Central Depository System, transfer of shares under Central Depository System. Understand that in this case you are transferring shares electronically. Look at advantages of Central Depository System. Advantages of Central Depository System. Then the following persons may open CDS account. So these are persons who can open CDS account. Okay. Then the continuation is there. These persons can open CDS account. Need to open a CDS account. How to open Central Depository System account. Functions of Central Depository System. Functions of Central Depository System, the CDS. Then we have parties involved. Parties involved in CDS. Parties involved in CDS: government, capital markets authority, CMA, Nairobi Securities Exchange, investors, brokers, banks. So CDS, those are parties involved. So that's it about CDS. So for CDS, we do not have much about CDS, but it's simply because of the application of technology in all aspects of our lives. The same applies with the shares. When you are in the stock exchange or the stock markets, everything is being done through electronic means. Is a way of doing business in the stock exchange through application of technology. So in this case, we are dealing with Central Depository System, CDS. So we have said that Central Depository System acts as a means of representing ownership and movements of securities. Central Depository System account holders enjoy the convenience of obtaining electronic securities transfer and trade settlements. We have advantages of CDS. So the advantages of CDS is just like advantages of using computers. Things like speed, things like accuracy, things like efficiency, transparency, reducing fraud. So it's the shortest. It shortens the registration process in the stock exchange. So you use the Central Depository System to trade shares. It shortens the registration process in the stock exchange. It improves the liquidity of stock exchange and increases the turnover of the equity shares in the market. So we have a variety of advantages. Then the functions we have just seen them. So I want to wind up the class now by looking at mortgaging and changing of shares. A mortgaging and changing mortgages and changes. mortgages, and charges. So if you have an asset and you want a loan from the bank, you can deposit the documents of ownership in the bank as a security or as a guarantee, and then the bank will issue you with a loan. If you default the payment, the bank takes your asset. I have an example where you have a piece of land and you have a title deed. This piece of land is worth 10 million. So you can deposit the title deed of your land in the bank. The bank issues you with a loan worth 5 million. So it means that in case you default the payment, the bank will take that particular piece of land, they will take it and then they can sell to recover their money. So mortgaging here means that scenario whereby you are using your asset as a security to secure a loan from the bank. It is used by the bank in this case. The bank or the lender simply is using your documents of ownership as a security, in the sense that if you default in payment, the bank will be able to take now your assets. Okay, that's mortgaging here. And chances, the same applies when it comes to shares. If you have shares, that is money. So you can deposit your share certificate to the bank, and the bank lends you money. Meaning, if you don't pay, what happens? The bank will exercise the lien over your shares. So they will take your shares now. The bank will take all your shares and then it will start now receiving the dividends in that case. So here we will talk of mortgages and chances with respect to shares. We are looking at those situations where you can use your shares as a security to secure financing, mortgages or mortgaging and changing of shares. Shares may be used by the company as a security or collateral to secure a loan. The same way that a person who has a loan book can transfer his loan book to the bank and the bank advances a loan, the same can happen with shares. If, for instance, you have a car valued at shilling 700,000, you can transfer your loan book to the bank and the bank will lend you shilling 700,000. If you default in payment, the bank will take your car and auction it. When it comes to shares, the concept is just the same. Mortgages are classified into two. One, legal mortgage. Number two, equitable mortgage. A legal mortgage involves the transfer of shares by the borrower to the lender, subject to the retransfer upon payment of the said borrowed amount. The lender becomes temporal owner thereof. Upon payment, the shares are retransferred to the borrower, but in the event of default, the transfer becomes absolute. So legal transfer here we are saying, you take your share certificate to the bank gives you money. The time you complete paying the bank, it will return your share certificate. But if you default in payment, then the bank takes now your shares. That's a legal mortgage. Equitable mortgage. This entails depositing the share certificate and a blank instrument of transfer with the lender. Equitable mortgage. So we are saying you take the share certificate as well as blank instrument of transfer. So why are you having the blank instrument of transfer? Is the reason being, if you default in payment, the bank, because they have the instrument of transfer, they will fill that form indicating that you have transferred your shares to them and these shares now belong to them. So in this case, you are being told with the equitable mortgage, you are being told you want money from the bank, that's okay. The security is the shares that you have. So what you do, go and bring your share certificate of that bank, of that particular company, alongside instruments of transfer, and then you are given money. If you don't pay or you default, because the bank already has your share certificate and they have instruments of transfer, if you default, they'll just fill the form indicating that you have transferred your shares to them, and therefore the bank becomes a new shareholder. It is the bank now which will be receiving what? The dividends. So you stop from being a member. That's an equitable mortgage. So you must have noted the difference between legal mortgage and equitable mortgage. You say equitable mortgage entails depositing the share certificate and a blank instrument of transfer with the lender. The borrower retains title and membership with all the rights exercisable by a member other than the transfer. The lender acquires equitable title on shares. Upon repayment, the share certificate is returned to the borrower, but in the event of default, the lender is entitled to transfer the same to himself or to a third party. This is done by completing the blank instruments of transfer and executing it properly. Okay. So you have mortgaging and changing of shares. Mortgaging and changing of shares. Mortgaging and changing of shares. We have this. We have legal mortgage. I've given legal mortgage, and I have given equitable mortgage here. Now we have differences between legal mortgage, differences between legal mortgage and equitable mortgage. Can you go through that? Differences between legal mortgage and equitable mortgage. I go to allotment of shares now. You're winding up. Now, application. We are doing application. We have done application and allotment. You apply for the shares. If the process is complete, you are allotted the shares. Allotment of shares. An allotment is a company's acceptance of an offer by any investor to buy its shares. It is governed by the following rules of common law relating to contracts. These are rules which govern allotment of shares. 1. The acceptance by the company must be unconditional. Number 2, the acceptance must be communicated to the applicant. Number 3, when the company issues a prospectus, the issue is an invitation to treat, but not an offer. Number 4, if the issue was oversubscribed, the company would be sued by the applicants who were not given the shares they had applied for. As this appears to be unjust, common law has avoided the eventuality by regarding the issue of prospectus merely as an invitation to treat. The above common law rules have been modified by the following statutory provisions. 1. We have void allotment and voidable allotments. Void allotment. An allotment is void if it was made by a body corporate which is not a registered company without the consent of the treasury. B. An allotment is void if it was made before applying for or obtaining stock exchange permission for the company shares to be dealt with in the stock exchange. These are void allotments. Then voidable allotments. If the allotment is made in breach of the Company Act by having been made before minimum subscription was raised. Number B, if the allotment is made before the prospectus or statement in lieu of prospectus, if any, was to be delivered to the registrar for registration. So that's what about allotment of shares. Allotment of shares. So you have allotment of shares, You go through these. Allotment of shares, we have void allotment, and then we have voidable. Void allotment, then voidable allotment. I believe we are through with that. So chapter 4, we are through with that. So this is what we are supposed to cover in chapter 4. Classes of shares, variation of class rights, share certificates, issue and allotment, transfer and transmission, transfer of shares under central depository system, mortgaging and changing of shares. So I think we are through with that particular portion. So chapter 4, we have done that particular portion about classes of shares. We have done class of shares for their variation of class rights, share certificates, issue and allotment, transfer and transmission, transfer of shares under central depository system, mortgaging and changing of shares. Well, we are through now with chapter 4 of company law. We'll be moving now to chapter 5. We'll be moving to chapter 5. So we've done that portion. So chapter 4 is about shares. We have reached chapter 4 shares. So next lesson we'll be moving to share capital. We'll be moving to share capital. So far we have done chapter 1. We've done chapter 1. Chapter 1 Chapter 1 was about nature and classification of companies. We have covered that. Chapter 2, formation of companies. And chapter 3, membership of a company. Chapter 4, which we have done, is the shares. Now, chapter 5 now we'll be moving to share capital, so you can start preparing in advance. Chapter 5 is about share capital. We'll be taking meaning and types of share capital, raising of share capital, prospectus or information memorandum, maintenance of capital, then alteration and consolidation of share capital, and then dividends. So that will be our next chapter. That is chapter 5, share capital. Share capital will be the next. The next thing will be that. So our lesson is almost coming to an end. So we come to the end of our class for today about company law. My name is Mr. Williams of Fatima Training Institute Center for CIFA Studies. Even though we brand ourselves as a Center for CIFA Studies, we brand ourselves as Center for CIFA Studies. We brand ourselves because somebody was asking me why we call ourselves Center for CIFA Studies. It's not because we are CIFA ourselves. CIFA means Certified Investments and Financial Analysts. It's not because we deal with certified investments and financial analysts. We also deal with certified public accountants. So, if you are taking a CPA or ATD, we also deal with the ATD students. In this case, we also deal with the ATD students.